समझ नहीं आ रहा अपने सैलरी इंक्रीमेंट का क्या करूं।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स के एसआईपी का टॉप अप करा ले। दिस इज द राइट टाइम।
क्या? समझ में नहीं आया।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स का एसआईपी टॉपअप करा ले। दिस इज द राइट टाइम।
अब समझा।
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Hello and welcome to ThePrint. This is Bidisha and you're watching Economics. Let me start with something that happened 2 days ago in Hyderabad. Prime Minister Narendra Modi stood before a massive public gathering at the Secunderabad Parade grounds and made an unusual kind of appeal. Not a policy announcement, not a budget line, but a personal ask directly to you, the Indian citizen. Work from home if you can. Don't buy gold for a year. Skip the international holiday. 3 requests, simple, specific, and to many people, it seemed a little puzzling. Some heard it and thought this is symbolic. Others thought this sounds impractical. And a few asked, is he serious? I want to show you today that he was very serious. That behind each of those 3 requests is a specific, measurable, verified pressure point in India's economy. And that once you see the numbers, you will understand not just what Modi said, but why he had to say it. Every economic story has a geography. This one starts with a map. When you find the Persian Gulf in the map, trace your finger to where it narrows and opens into the Arabian Sea, squeezed between Iran on one side and Oman on the other. At its narrowest point, it is barely 33 kilometers wide. You could drive across it under half an hour. That is the Strait of Hormuz. And through those 33 kilometers, before this crisis began, passed 20% of the world's entire oil supply. Every single day. 20 million barrels, the oil that becomes the petrol in your car, the LPG in your kitchen, the jet fuel in every aircraft that lifts off a runway, 1 in every 5 barrels of the world's oil. Through a gap you could sprint across in theory. On February 28 this year, the United States and Israel launched strikes on Iran. Iran's strategic response was immediate. It moved to shut the Strait of Hormuz. Today, as we record this, that strait remains effectively closed. Traffic is running at roughly 5% of its pre-war average. Over 1,500 vessels are stranded. Tens of thousands of mariners are trapped. The world's largest oil companies have even suspended transits. The International Energy Agency has called this the largest oil supply disruption in the history of the global market. Larger than the 1973 oil shock, larger than anything we have seen in the modern era of energy markets. The price consequence was swift and brutal. Brent crude, the global benchmark for oil, the wholesale rate the world pays before crude becomes petrol or diesel, crossed $126 per barrel last month. This week, it is sitting around $105 to $107. A year ago, it was around $65. We have come close to doubling in 12 months. For most importing nations, that is a serious headache. For India, it is something structurally deeper. And this is where the real story begins. Now, the first question is, why does India feel this differently? Here is the single most important fact to hold in your head for everything that follows. India imports approximately 88% of the crude oil it consumes, 9 in every 10 barrels. We produce almost nothing domestically relative to what we need. And historically, roughly half of that imported oil came through the Strait of Hormuz. Which means when Hormuz closes, India is not watching an energy crisis from a distance. India is inside it. Now, I need you to understand one concept. It may sound dry, but it is in fact the engine of everything Modi said in Hyderabad. The current account deficit. Here is what it actually means. Think of India as a household. Every month, this household earns income from the rest of the world. From the software services our IT companies sell globally, from goods we export, from the billions our diaspora sends home from the Gulf, the US, the UK, that is what flows in. Every month, this household also spends on the rest of the world, on imported oil, on gold, on electronics, on goods we cannot make ourselves. This is what flows out. Now, when outflows exceed inflows, the gap is the current account deficit. It is simply how much more India is spending on the world than it is earning from it. And when that gap grows too wide, it puts pressure on the rupee, our currency. Because India needs to sell more rupees to buy the dollars it needs to pay for all those imports. Right now, that gap is widening at a pace that has alarmed every serious economist watching India. Here is the precise number from the reports so far. Every $10 increase in Brent crude prices widens India's current account deficit by approximately 0.4 percentage points of GDP. GDP is simply the total value of everything India produces in a year. So 0.4% sounds small, but Brent has moved from roughly $65 to over $120. That is a $55 increase. Multiply that through, and India's current account deficit has potentially widened by over 2 percentage points of GDP in a matter of months. In months, not years. And the rupee is where ordinary Indians feel it. A year ago, $1 bought roughly 86 rupees. Today, it costs 95 rupees. The rupee has lost nearly 11% of its value in 12 months. And here is the cycle that's worrying. A weaker rupee makes every imported barrel more expensive in rupee terms, which widens the deficit further, which in turn weakens the rupee more. It feeds on itself, and breaking that cycle is not easy and not fast. This is the economic pressure cooker that Modi was responding to in Hyderabad. Now, here is what I find genuinely well constructed about this appeal. Modi did not stand up and talk about current account arithmetic. He spoke in the language of everyday life. 3 simple asks, and yet each one maps with surgical precision onto a specific hemorrhage point in India's external balance. Think of India's import bill as a patient's chart. The diagnosis shows 3 main sources of bleeding. Modi named all 3. The first, work from home, carpool, use public transport. Now, this first is about oil. India's crude oil and petroleum import bill last financial year was $123 billion. That is, in fact, the single largest contributor to India's import expenditure. Larger than electronics, larger than machinery, larger than anything else we buy from the world. Now, you might ask, why not just fix this through policy? Why is the Prime Minister asking individuals to change behavior rather than the government adjusting fuel taxes or the RBI managing the exchange rate? Here is why. Monetary policy, the Reserve Bank's toolkit of interest rates and liquidity management, works on a long lag. Typically 6 to 18 months before it meaningfully moves economic behavior. We do not have that runway. The pressure is here now. What moves faster is behavior. If millions of Indians who have the option to choose to work from home a few days a week, that is millions of car journeys not taken, millions of liters of petrol not burned, millions of dollars of crude oil not imported, it does not eliminate the problem, but in economics, the margin always matters. At the margin, it reduces pressure on foreign exchange, the stockpile of dollars and other currencies the RBI holds to pay for imports and defend the rupee. It buys the system some breathing room. Prime Minister Modi was not being nostalgic for the pandemic. He was reaching for the only policy lever that produces results at speed, voluntary demand reduction at scale from the bottom up. The second, pause gold purchases for a year. Now, this is the one that surprised people the most. What does gold have to do with a war in the Strait of Hormuz? Everything. Look at the numbers. India's gold imports in the financial year 2025-26 hit $72 billion, a 24% jump from the previous year, $58 billion. Both consecutive all-time records. We import nearly 85% of the gold we consume. We mine almost none domestically. Now, here is the economic reality of that purchase stated plainly. When you buy a gold bangle or a gold coin at the macroeconomic level, that transaction is a dollar leaving India. The gold must be physically imported. It is paid for in foreign exchange. It generates no employment in India, it builds no productive capacity, it produces no future income stream for the economy. It simply exits and lands directly on the debit side of that current account we just discussed. And the timing matters enormously. Our current account is already under acute stress from a $123 billion oil bill. Layering a $72 billion gold import bill on top of that simultaneously, that is a double hemorrhage. Both happening at once, both in foreign exchange, both widening the gap that is already weakening the rupee. Modi's request is not to abandon gold culturally or permanently. It is a one-year pause. Let the storm pass before adding to the outflow. At the macroeconomic level, it is entirely rational. The third, postpone unnecessary foreign travel. This one is the most straightforward of the three and the most immediately actionable for the middle and the upper middle class. When you travel abroad for leisure, a holiday in Dubai, a trip to Europe, a family vacation in Thailand, you spend dollars, euros, and even dirhams. That is foreign currency physically leaving India's external account. Your hotel bill, your shopping, your restaurant meals, all of it registers as an outflow on India's balance of payments. Indians traveling abroad spend $31.7 billion in the 2023-24 financial year, and that number has been growing every year. Cumulatively, for across tens of millions of travelers, this is a meaningful current account outflow that worsens the pressure we are already under from oil and gold. Modi's ask is narrow and time-bound. Not forever, not for work travel, just unnecessary leisure travel for now, while the external account is under this degree of stress. 3 requests, 3 import lines, oil, gold, travel. Each one a diagnosed bleeding point. Each one chosen because it is large, measurable, and unlike oil prices themselves, it is partially responsive to individual behavior. Let us now make this a little personal, because macroeconomics without application is just academic commentary. First, maintain perspective. This is stress, not collapse. India's foreign exchange reserves remain substantial. The RBI holds a significant buffer. Remittances from the Indian diaspora, among the world's largest, continue flowing in steadily. The government has been aggressively diversifying crude sourcing, importing oil from over 40 countries as of March 2026. The institutional framework is holding. This is a serious external shock. It is not a crisis of solvency. Second, watch what comes next in policy. Modi's Hyderabad speech is stage 1 of a policy conversation, not the last word. What typically follows a public appeal like this are harder structural measures. Adjustments to import duties, recalibration of domestic fuel prices, incentives for domestic energy alternatives. Reports estimate India's current account deficit could widen to 2% of GDP even if oil averages $82 to $87 per barrel. We are trading well above that. The policy response will need to be proportionate and we'll have to watch for it. Third, position your personal finances with the new reality in mind. On gold, domestic prices are hovering around 1,50,000 rupees per 10 grams. That is a historically elevated entry point for new purchases. If you want the inflation protection gold provides, and there are legitimate reasons to want it in this environment, consider sovereign gold bonds or gold ETFs instead of physical gold. Let me explain the difference plainly. A sovereign gold bond is a government security whose value tracks the gold price exactly. A gold ETF is a fund on the stock exchange that does the same. Both give you every rupee of gold's price appreciation. The sovereign gold bond additionally pays 2.5% annual interest on top of that. And crucially, neither requires India to physically import gold. Your investment is protected, the country's current account takes no additional hit. For the informed investor at current price levels, this is strictly superior to buying physical gold. For equity investors, the rupees fall from 86 rupees to 95 rupees is not uniformly bad news. It is a signal about where to be positioned. Export-linked sectors, IT services, pharmaceuticals, specialty chemicals earn in dollars and report profits in rupees. When the rupee weakens, their domestic profitability improves without any change in their underlying business performance. That is where the currency mathematics works in your favor in this environment. Now, I want to end with the question that I think honest economic commentary cannot and should not avoid. The macroeconomic logic of Modi's appeal is sound. I have shown you the arithmetic. I am not disputing the aggregate case. But as an economist, my job is not only to validate the aggregate, it is to ask who sits behind it. Work from home is a privilege that belongs to a specific slice of India's workforce. The salaried professional with a laptop, a broadband connection, and a manager who permits remote work. But the overwhelming majority of India's working population cannot log into a meeting. The daily wage laborer, the construction worker, the factory hand, the auto rickshaw driver, they commute because their livelihood requires physical presence every single day. They get none of the optionality Modi's first request assumes. And yet, when petrol prices rise, when LPG cylinders become more expensive, it is their household budget that absorbs the cost first, hardest, and without recourse. Gold cuts even deeper. For tens of millions of Indian households, particularly in rural and semi-urban India, gold is not a portfolio allocation or a speculative asset. It is a family savings account. It is an emergency fund, a collateral rolled into one physical object. It is what you pledge when there is a medical crisis and no bank will lend. It is what a woman holds as her own financial security in a household where formal banking remains inaccessible. Asking these families to pause gold purchases without offering them a genuinely accessible alternative store of value is asking them to hold more of their wealth in rupees, a currency that is actively and measurably losing value. That is a real cost. Sovereign gold bonds are an excellent instrument, but their penetration in lower income and rural India remains limited. The distribution infrastructure to make them truly accessible at scale simply does not yet exist. So here is the tension at the heart of this moment. The aggregate numbers justify the appeal, but the distribution of sacrifice does not sort itself equitably just because the aggregate logic is correct. In economies marked by deep inequality, and India's is, the burden of macroeconomic adjustments tends to fall disproportionately on those least equipped to bear it. The people with the most capacity to absorb the shock often face the least pressure to adjust. The people with the least capacity end up adjusting anyway, because the price of every essential good they buy goes up whether they participate in the appeal or not. That is not a reason to dismiss Modi's ask. It is a reason to demand that the policy measures which follow it are more equitable than the appeal itself. The ask has been made in the language of collective sacrifice. The response from the government must be in the language of proportionate burden sharing. So here is where I leave you. Modi's appeal is not a directive. It is an invitation to understand the economy you live in, to see the stress points that are building and to act where you genuinely can. But every invitation assumes the invitee has the option to RSVP. For millions of Indians, on the oil question, on the gold question, there is no RSVP. The adjustment happens to them whether they choose it or not. Petrol gets expensive, the cylinder gets expensive, the rupee in their pocket buys less, the appeal reaches them last, the consequences reach them first. My instinct would be to hold that truth alongside the macroeconomic logic, not to let one cancel the other. Both are real, both matter. And the policy conversation that follows this speech, the import duties, the fuel price decisions, the alternatives offered to ordinary savers, that is where we will find out whether the burden of this moment is being shared with any honesty at all. I'll be watching, and so should you.